Netflix stock has been on fire in recent years, and rightfully so, in my opinion. The company's management team has done an excellent job with every major decision they had in the last 5 years, or nearly every major decision in the last 5 years. The company is scheduled to report quarterly financial results after the markets close on April 17th, 2025, and investors are asking me if they should buy Netflix stock before the company announces earnings. I'll answer that question in this video. I'll also share with you my proprietary discounted cash flow model for Netflix so you can see my calculation for what I feel is a fair value for Netflix stock, and preview what investors should look out for from Netflix in its upcoming earnings release. And of course, let you know what I think about buying, holding, or selling before or after the company announces earnings.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So let's start out with what investors should look for from Netflix when they announce the earnings in just a couple of weeks here. Netflix management told investors to look out for 2025 revenue of around $44 billion, which was a $500 million increase from the previous forecast. They also increased their profit margin expectations for 2025 up to a whopping 29%. That's the best in class of any streaming company that I'm aware of. The company's doing a fantastic job not only adding millions of new subscribers, but doing so while expanding their profit margins. They've got that formula for operating a successful streaming business. They are the absolute leaders, and second place is far behind. For the current quarter, Netflix is forecasting revenue of $10.46 billion with an operating margin of 28.2%. If the company meets those expectations, that would be an increase of 11% on revenue. And then looking at the expansion in operating profit margin would be flat year over year or up very slightly. Netflix stopped forecasting their membership expansion plans, but they did say that they will report on these big milestones when they hit them. In the most recent update, they said they had over 301 million global subscribers, and that was up 16% from the same quarter last year, an increase of 19 million subscribers. That was a truly impressive increase. Part of the reason for those increases are the company's ad-supported version, which the management team said nearly half of new signups are coming through the ad-supported version. So that's clearly been a successful business decision from Netflix management standpoint. The other very successful decision has been to stop allowing households to share accounts, cracking down on password sharing. And since people cannot share these accounts, they've opted to open their own account. And that's created another catalyst for growth for Netflix over these last few years. I also liked how the management team, when they faced the increase in competition from streaming competitors, they chose to raise prices instead of cutting prices. I thought, as the leaders of the industry, that was a great move because what you've noticed is the followers, everyone else, has also increased prices. So what that's done for investors is increase profit margins industry-wide. You always like to see industries engage in this type of action as an investor. As a customer, you don't like to see that, right? Because if you're like our household, we have several streaming memberships and they've all gone up. The prices have all gone up. But from an investor perspective, it's great news, right? Because you see the higher profit margins industry-wide. So looking at my discounted cash flow model for Netflix, I calculated an intrinsic value per share of $828. The current market price is $935. I typically allow for a margin of safety between 5 and 15%. And in this case, the intrinsic value is within the range of the margin of safety. So I can't go out and say that I think Netflix stock is overvalued, but I can say that I don't think it's undervalued at current prices. It's either fairly valued or a little bit richly valued at current prices. Also, I just wanted to make a note of this new upgrade in the spreadsheets. I added this purple section, which automatically updates a company's trailing 12-month earnings per share, the price to earnings on a trailing 12-month basis, the daily price change, and the company's 52-week high and 52-week low. Those of you that have access to the spreadsheets, you'll now be seeing these added for the companies. I'm going through and adding a few every day, this automated section to the spreadsheet to help with your decision making if these factors are things like myself I consider when making a decision about an investment. I thought it'd be helpful for you all here. Another way I look at valuation is measuring a company on the forward price to earnings. And on this metric, at a forward PE of 31, Netflix stock looks undervalued. If you look at the company's revenue growth, the total addressable market, the competition, the risk, the unit economics, all of which are attractive or extremely attractive for Netflix stock investors. So this is the kind of business that I would be interested in paying a premium valuation for. I see other businesses that are trading at super premium valuations that I have no desire to pay those super premium valuations because those businesses are in industries that I see as being unattractive. Competition is unattractive, risk is too high, and then the valuation is super expensive. So those are industries I try to avoid. And the primary example, of course, is Tesla, which has the opposite of what Netflix has: poor competition in the industry that's intensifying, auto industry company where margins in the auto industry are very skinny overall, and then the risks with the very high valuation that's very dependent on the company developing a technology it has not even scratched the surface on in terms of generating any revenue or profit. And so all of those make it unattractive. It's like the opposite here with Netflix. A great industry, love the competition. Everyone is raising prices and cutting content spending. The margins of 30% on this type of industry is very attractive. All that being said, should you buy Netflix stock before the company announces earnings? I would say no. I would lean against that because of how much the stock price has run up already. Also, because looking at the discounted cash flow and the forward price to earnings, it's trading at near its highest valuations it's traded for over the past few years. And there's a lot of uncertainty in the stock market right now. President Trump, I just watched the live session where he announced reciprocal tariffs on most of the United States trading partners. We want to see how that plays out. And the elevated risk, why take the elevated risk? There is no reason to in this case because the stock is not extremely undervalued where there is risks to the stock jumping so much after the earnings results. This is one of those situations where I feel it's more prudent if you're interested in Netflix stock, wait for the earnings to come out, digest the new numbers, look at the new valuation, and make your decision then. Hey everyone, I'm excited to announce a brand new private Discord for our channel members at the VIP Discord level. It's a great place to connect with me directly, engage with like-minded investors, and learn more and take your investing to the next level. Spots are limited, so join now before it's too late.